Ever wondered how the rich seem to get richer, especially when things go south for the rest of us? It's a pattern we see time and time again. A global crisis hits, markets panic, and yet somehow, billionaires emerge with even more wealth. How do they do it? Is it magic, or is there a playbook they all follow? Today, we're pulling back the curtain on the strategies the ultra-wealthy use to turn crises into gold mines. This isn't about shaming success. It's about understanding the mechanics of a system that often seems to work in their favor. Stick around, because what you're about to learn might just change the way you see the world of finance forever. First, let's talk about the most powerful tool in their arsenal: cash. When a crisis hits, whether it's a pandemic, a housing market crash, or a war, fear takes over. People sell their assets, stocks, real estate, everything often at a loss, just to have cash. This is what's called a liquidity crunch. But for billionaires, this is a shopping spree. They've been sitting on massive piles of cash, just waiting for this exact moment. While everyone else is selling low out of fear, they are buying low with confidence. Think about it. When stock prices plummet, they're not seeing a disaster. They're seeing a discount. They can buy up shares of solid, fundamentally strong companies for a fraction of their usual price. It's the ultimate buy-the-dip strategy, but on a scale most of us can't even imagine. This leads us to the concept of dry powder. It's a term from the old days of warfare, meaning keeping your gunpowder dry so it's ready when you need it. In finance, it means having liquid assets, cash, or things that can be quickly converted to cash ready to deploy. Billionaires and their investment firms are masters of this. They don't have all their money tied up in one place. They maintain a strategic allocation to cash precisely for these black swan events. So when the market tanks 30%, they're not panicking about their portfolio. Instead, they're calling their brokers and saying, "Start buying." This isn't just about stocks either. It applies to real estate, private companies, and even distressed debt. A business struggling to make its loan payments during a recession might be forced to sell assets cheaply, or even sell the entire company. Who's there to buy it? You guessed it. Now let's get into the nitty-gritty of their investment vehicles. Many billionaires don't just own stocks like you and I do through a simple brokerage account. They operate through family offices, private equity firms, and hedge funds. These sophisticated operations give them access to deals the public never sees. For example, during a crisis, a promising tech startup might be desperate for funding to survive. A venture capital fund, backed by billionaire money, can swoop in, provide the cash, and in return, get a huge ownership stake at a bargain valuation. They are essentially buying the future at a massive discount. They also invest in things like distressed bonds. When a company is on the brink of bankruptcy, its bonds might trade for pennies on the dollar. A hedge fund can buy up these bonds, and if the company recovers or gets bought out, those bonds can soar in value, turning a small investment into a fortune. It's high risk, but with the right research and a diversified portfolio of these kinds of bets, the rewards can be astronomical. Another key advantage is access to information and influence. Let's be real, billionaires are not just passive observers of the economy. They have networks that stretch into the highest levels of government and industry. They have teams of analysts working around the clock to decipher market trends and economic data. This information edge is critical. While the average person is reacting to news headlines, they are often positioned well before the news even breaks. They also have the ability to influence policy. During the 2008 financial crisis, for example, massive government bailouts were designed to stabilize the financial system. But who are the primary beneficiaries? The very banks and institutions that were too big to fail, many of which are owned or heavily invested in by the ultra-wealthy. These policies, intended to prevent total collapse, often have the side effect of protecting and even enhancing the wealth of those at the very top. By lobbying and having a seat at the table, they can help shape the rules of the game in their favor. It's also crucial to understand their mindset. The average investor is often driven by emotion. Fear of missing out, or FOMO, pushes them to buy at the top. Panic pushes them to sell at the bottom. Billionaires, on the other hand, cultivate a mindset of detached, long-term thinking. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This is their mantra. They see market crashes not as a threat, but as a once-in-a-decade opportunity. They have the psychological fortitude, and frankly, the financial cushion to withstand short-term paper losses. They know that historically, markets always recover. So if their portfolio is down 40% one year, they don't panic. They either hold on, confident in the long-term value, or they buy even more. This long-term perspective is a luxury that many people, who might need their investment money for retirement or a down payment next year, simply don't have. So let's recap the billionaire crisis playbook. Step 1. Hoard cash and maintain dry powder during good times. Step 2. When a crisis hits and panic ensues, deploy that cash to buy undervalued assets, from stocks to entire companies. Step 3. Use sophisticated investment vehicles like private equity and hedge funds to access exclusive deals not available to the public. Step 4. Leverage information networks and influence to anticipate market moves and shape favorable policies. And Step 5. Maintain a long-term, emotionless mindset, viewing crashes as opportunities, not catastrophes. What can we, the everyday person, learn from this? We might not have billions, but the principles can be scaled down. First, having an emergency fund is our version of dry powder. It prevents us from being forced to sell our investments at the worst possible time just to cover an unexpected expense. Second, learning to control our emotions is key. Making a plan and sticking to it, rather than reacting to scary headlines, can save us from costly mistakes. Investing regularly, through a method like dollar-cost averaging, helps us automatically buy more when prices are low and less when they are high. And finally, focusing on the long term is paramount. Investing is a marathon, not a sprint. The market will have its ups and downs, but history has shown that patience is rewarded. We may not be able to buy a distressed corporation, but we can buy a low-cost index fund at a 20% discount, and that's a powerful move in itself. Understanding these dynamics isn't about fostering resentment. It's about financial education. It is about seeing the game for what it is and learning to play it smarter with the resources we have. The system may be skewed, but knowledge is the great equalizer. By understanding how wealth is protected and grown during downturns, we can make better decisions for our own financial futures. Thanks so much for watching. I hope this gave you a new perspective on how wealth works in our world. If you found this interesting, do me a favor and hit that like button and subscribe for more deep dives into the world of money and finance. Let me know in the comments what you think. See you in the next one.